I've been telling all of our startups that you need to plan to have money through the first quarter of 2025. You must.
Whoa. Yeah. Okay.
You absolutely must. And
That's
the
8
way that
quarters of cash. Okay.
the way that I frame that out to them is 9. Yeah, 8 or 9 quarters of cash. Ideally 9. And the reason is that we have all of this positive news in the offing, but the problem is, again, there is still a lot of risk to the downside. We haven't seen David's second, dip in the recession, right? So that double dip is going to be expensive. And again, the sharps think that inflation will come back at some point in the next 6 months. That will keep the Fed's foot on the gas. Maybe it's 2 or 3 more 50 basis point hikes. The point is, Jason, you could be at 5.5. Again, we said this last week. We're going to get to a point that's probably higher than what people expect. That's probably around 5.5. And we'll stay there longer than people want. That's probably through the middle part of 24. And if you don't prepare for that worst case scenario, you're doing yourself a disservice. I think the market can start to rebound in the second half of 24. But if you're a company, you need to balance and plan for the first quarter of 25. Because, again, most venture investors are going to want to see 6 months of data on the ground that things are better before their sentiment changes.
Yeah.
And we're just starting to see the drawdowns. We're just starting to see the impacts in people's portfolios. That will drive behavior change. I mean, this SBF thing is the tip of the iceberg in terms of the money at risk. I went and, by the way, I did an analysis. I shared it in the group chat. Hopefully we can show this up. Brad has a little chart. Nick, maybe you can throw up the historic drawdowns. So for people that care about early stage technology, since 2018 through 2021, and including an estimate for 2022, we have injected $1 trillion into venture capital. And if you look at historically how money has been lost in periods like this, and you layer that into 2018 to now, what it basically tells you is about $500 billion of that trillion from 18, 19, 20, 21, and 22 is going to be destroyed. We haven't even started to see that yet, right? And then if you factor in another 100 billion or so from older vintages, we're talking about a 600 or 700 billion dollar destruction of paid in capital. So there's still, for all the good news, there's still a bunch of these unfortunate pieces of bad news that have to work its way through the system.
Yeah. And for people who are looking at the chart right now, and you can see the charts on Spotify, or if you search for All In on YouTube, we have a video version there. You just take a look at 1997. The peak TVPI was, 7.5x, 7.5 times, cash on cash money. And what actually got realized was 5x, right? So what paper said and what got distributed were two different things. Anecdotally, what I'm seeing in the startup world, Chamath, is people are taking the medicine, and a lot of people are shutting their companies down. They're giving up on raising money and then asking me, which portfolio company can I get a job at? Because I, on my personal balance sheet, have been, taking a 5K draw a month, and I have 2 kids. I need a job. Can you get me a job at Amazon or another portfolio company? And a lot of acqui-hires have started to happen. And so what's happening is the consolidation of talent. People who would be a great number 3 or 4 person, but maybe they weren't suited to be the number 1 person, are now consolidating into startups. With these layoffs at Meta and other corporations, we're starting to see very talented people who had peak comp of 300, 700K a year are going to go to startups or go to smaller companies. And that is also positive. More consolidation of talent, stronger companies.
Did you guys hear the story yesterday that, Nick, if you could just bleep out the name, told about his friend? His friend basically makes $140,000 working for a tech startup, and then also makes $280,000 working for Meta. And he's been working at both of those companies virtually for the last 2 years. The guy makes $450,000 a year, and nobody knows. And he says he works about 22 hours a week.
On both combined. So the 80 hours. And remember, when we started in startups in the late 90s and into the turn of the century, the number of hours that was expected at a startup was what, Sachs, when you were at
60
PayPal?
hours a week, I would say.
60 to 80.
That was expected, baseline,
yeah,
60.
That was baseline, yeah.
Baseline 10 hours a day plus come in on the weekend for a couple hours.
Yes.
Yeah.
For sure, easily.
Easily. Probably more.
Early days of Facebook, our executive management meetings wouldn't start till 9 p.m.
Yeah.
I think Elon's going to be a trailblazer in a lot of ways on this Twitter thing. First he did the big headcount reduction, but then he also, just this past week, said everyone needs to come to the office. And if you don't come to the office, you don't have to come to the office. You have a good excuse. If you're an exceptional performer and you've got a good reason, then you don't have to. But the baseline is everyone comes to the office.
By the way, just to put this point into focus, Nick, can you just throw up this chart for these guys to see? Because I think it's just ridiculous. So this is basically what we're dealing with, which is like if you look at, and these are just a couple of examples, but this is Meta, Amazon, Snowflake, Datadog versus Gilead, Raytheon, and Exxon. What is the point of this? The point of this is just to show you that we have had a massive rotation away from our industry, is the point, right? Where normally the things that we would work on were just so well received by so many different kinds of investors that unfortunately just isn't the case anymore. And I think it just goes to show you that the reason why this is happening is because people are hedging their bets about how long the economic pain lasts. That's why, they'd rather be long healthcare stocks, industrial defense companies, and oil companies. Because at the end of the day, they're banking on oil and war and sickness, versus
social media and e-commerce and SaaS software. And if we look at this chart, just
no matter how good, by the way, so this is not an indictment on these companies.
Go watch the prediction episode from last year. I think
watch the prediction episode. Yeah, you and I nailed it on crypto. We both said crypto was going to crater. These four horsemen here: Datadog, Meta, Amazon, Snowflake down 23 to 27%, and then the Gilead, Raytheon, Exxon cohort 8 to 28% up. I think, Chamath, what this says also is, we don't think your management style and how you're running these businesses is appropriate for this moment in time. Please consider some austerity measures and some thoughtfulness in how you treat shareholders. Vis-a-vis, well, I mean, it's just watching the number, how people are running companies. I think we took it too far in Silicon Valley. We took it too far. I don't know,
J. Cal. I know it's sort of a pet issue of ours because we have to deal with some incredible hubris and arrogance sometimes on the boards of these companies because folks don't want to listen to reasonable advice and we come off as wet blankets. But that chart, to be honest, is because of what we explained last week, which is when rates go up, the value of a dollar that you earn today is just meaningfully more worthwhile than a dollar that you may earn even 2 or 3 years in the future. That's why that chart looks the way that it does. And if you believe that David's forecast of a double-dip recession is accurate, which, again, most of the sharps do, and then you also layer in this idea that inflation could come back, you have to be really defensively positioned. You can't take a lot of risk, which is why startups have to expect that if that's the dynamic and $600 billion is going to get destroyed in venture capital portfolios, how open are VCs going to be for business? They're probably not going to be that open. And so you have to plan, I think, for the early part of 25.
If Amazon, and how do you get incremental dollars in these tech companies? Amazon does a RIF, some austerity measures, they raise prices a little bit if they can. Maybe you see more incremental dollars coming today, and maybe that incentivizes people. Look at what happened. We were at $89 for Facebook shares last week, Chamath. When he made the RIF, 107. He went up like $15, $20. What does that tell you?
I mean, I think it tells you that a lot of people were short going into that, and they were probably caught offside a little bit by the magnitude of it. I think that that's good. The issue that a lot of these companies have, even in the face of RIFs, is that you have to reset expectations now on earnings. And if you do that, the problem is that when you flow that through to what people think the S&P will look like in a year, there's some real issues. So this is not free, It's really hard treading. And I would just encourage people, it feels wonderful to have a few days of it's like a respite in the middle of a huge storm, right?
Yeah,
it feels like we've been getting whipsawed back and forth, and feels
the sun
nice.
Came out and the wind went down.
Came out. I would just really encourage people in this moment to reset your energy, which I think is good. But you got to go back into that office and you got to find the money and the wherewithal, I think, to last through 24, if possible.
It's grind time. Facebook, by the way, 27.
18 months is not enough. You need at least 2 years.
2 years, yeah. 24 months is the new, eight quarters is the new 6 quarters.
And by the way, the thing that employees need to do now in this moment is to hold the management teams of your companies accountable, because in those Q&As, hopefully you're not just glad-handing talking about bullshit. You actually go and ask the question, how much money do we have? What decisions are you going to make to get this company to be, in a position to survive? That is really what's at stake here for the venture capital industry, is just survival of as many of these companies as possible through these next 2 years.
The conversation has to shift from like culture and features to like the bottom line and grinding it out and just proving it to Wall Street and to the investment community that your business is worthy of investment. As you're saying, the dollars today matter.